Okay, let's jump right into this explainer and untangle the hidden web of how corporate incentive structures in the mortgage industry create massive systemic risks. Now, we all know the mortgage industry provides a huge public good by helping folks buy homes. But today, we're zeroing in on exactly how poor lending practices can cause this vital system to go completely off the rails.
Before we get bogged down in the financial jargon, I want you to think about the human element for a second. Who ultimately bears the cost when a complex mortgage goes wrong? Is it the borrower who loses their house? Or maybe it's the investor whose portfolio suddenly plummets in value? Or is it the lending institution facing multi-million-dollar fines? Well, as we'll see, poor lending practices trigger a cascade of consequences that hit literally everyone, from the frontline consumer all the way up to the long-term shareholder.
So, here is our roadmap for today. Section 1 covers the hidden mortgage engine. Section 2 looks at the trap of misaligned incentives. Section 3 explores the cost of poor transparency. And finally, Section 4 details measuring the true risks. Basically, we're going to follow the money step by step, tracing a single dollar from a consumer straight to an originator's commission and eventually to costly litigation. Let's start with Section 1, the hidden mortgage engine, the human incentives behind the loans. To really understand the root cause of this issue, we first need to define the key players on the front lines. Those are the mortgage loan originators. Basically, these are the folks arranging and negotiating the extension of credit. They're the critical bridge between the lending institution and the borrower. But the absolute most important part of this definition is the phrase, for compensation or other monetary gain. Their entire livelihood depends on closing these deals. And that brings us to the engine driving them, remuneration. We aren't just talking about a flat, predictable hourly wage here. The source material highlights that compensation structures heavily utilize bonuses, commissions, pooled compensation, and profit sharing. Crucially, these financial incentives are often tied directly to the specific terms and conditions of the loans they originate. We're talking about things like the size of the mortgage, the interest rates, or upfront points. In short, how a loan officer gets paid directly dictates exactly what kind of loans they try to sell. Moving right along to Section 2. The trap of misaligned incentives when pay structures push risky products. Let's contrast two very different approaches to pay. An aligned incentive focuses on long-term client success. It's totally neutral to specific loan terms, kind of like a flat fee. But a misaligned incentive, that accidentally pushes originators to promote entirely unsuitable lending products just to hit a bonus. Think about it. When compensation is tied to upfront fees or the immediate ability for the bank to securitize and sell off that loan, the loan officer is financially rewarded for pushing aggressive, complex products. And that happens regardless of whether the borrower can actually afford them in the long run. So the real danger here is that misaligned incentives bloat a company's portfolio with highly risky loans. Just look at the specific types of residential mortgages that signal elevated risk. You've got combined fixed and variable rate loans, specifically those with interest rate resets of less than 5 years, which can cause massive, sudden payment spikes for the borrower. You have prepayment penalties, which literally punish a customer with monetary fees just for trying to pay off their balance early. Then there are interest-only schedules, and perhaps the most dangerous of all, negative amortization. This is where the borrower is paying so little that the remaining interest is actually added back onto the principal. The debt grows instead of shrinks. If originators are incentivized to sell these, the entire entity's portfolio becomes a ticking time bomb. Let's get into Section 3, the cost of poor transparency, the fallout of aggressive loan pushing. When that first domino falls, meaning a misaligned incentive pushes a complex loan onto a customer, it triggers a massive chain reaction. If an entity lacks transparency about what these products actually do, the legal fallout is incredibly severe. We are talking about costly predatory lending litigation, massive civil settlements, intense regulatory proceedings resulting in disgorgement or restitution, and yes, even potential criminal judgments. It's an absolute nightmare for any institution's balance sheet. In fact, the source material explicitly warns us about this. It states, a lack of transparency provided to customers with respect to primary and add-on products may impair an entity's reputation and invite regulatory scrutiny and costly litigation. This isn't just a localized legal headache, folks. It fundamentally damages the entity's reputation and its long-term shareholder value. Provide transparent information and fair advice, and you protect your shareholders. Fail to do that, and you invite disaster. And the real-world result of these practices just sitting in a portfolio, it's devastating. Poor transparency inevitably leads to a surge in mortgage modifications, which is where the bank has to actually change the loan terms just to prevent a default. Even worse, it leads to short sales, where the bank takes a loss and accepts less than the full debt owed just to get rid of the asset. And ultimately, it results in forced property foreclosures. This is the very real, quantifiable failure of a bad lending practice playing out in real time. Which brings us to Section 4, Measuring the True Risks, SASB Disclosures as the Antidote. Now, what's truly interesting here is how the SASB metrics provide a standardized framework to force companies to disclose these exact vulnerabilities. We aren't just hoping companies do the right thing anymore. This is a rigorous accounting standard that categorizes and quantifies lending practices. It gives investors the exact visibility they need to compare which entities are actually protecting shareholder value and which ones are flying completely blind. Let's look at one of the most powerful tools in this standard. Metric FN FM270A3 requires the disclosure of the total monetary losses from legal proceedings specifically associated with customer communications, or the remuneration of loan originators. Basically, this metric ensures that all those civil settlements, regulatory fines, and legal costs we discussed earlier are brought to light. It perfectly isolates the financial penalty for bad behavior.
But, it's not just about the final penalty number. The standards require companies to explain the whole story behind that number. They have to disclose the nature of the judgment. Was it a settlement, a guilty plea? They have to explain the context. Were we looking at outright fraud or just terrible client disclosure? And most importantly, they must detail the corrective actions they've taken. Have they changed their management structure? Did they implement new employee training or upgrade their technology? This shows us if the company is actually trying to fix the root cause. And to stop the problem at its absolute source, there's Metric 270A.4. This requires entities to lay bare exactly how they incentivize their loan officers. Step by step, they must disclose the regulatory environment, outline their exact performance objectives, detail how that performance is measured, and crucially, expose the exact structure of variable remuneration. Investors absolutely need to know, are they using bonuses, profit sharing, or commission structures that are directly tied to risky loan terms? So as we wrap up this explainer, I want to leave you with this critical thought about corporate governance and transparency. We've seen how a simple, seemingly harmless commission structure can lead to a bloated portfolio of risky loans, resulting in millions of dollars in legal fines and devastating foreclosures. So I ask you, if you don't know how a company pays its salespeople, do you really know what you're investing in? The mechanisms of incentive dictate the reality of risk. Thanks for joining me on this deep dive, and keep asking the tough questions about the data behind the deals.